There's been plenty of media commentary in recent weeks on the potential re-emergence of inflation, and this marks a change in the headlines and also a change in market sentiment as developed economies have really struggled to escape from the low inflationary environment we've seen post the global financial crisis. In the UK, we're currently importing inflation as a result of sterling's significant slide against our trading partners and the rebound in the price of oil. And UK inflation-linked bonds have moved to price in inflation above 3%. At this level, they look relatively unattractive to us. Across the pond in the US, markets have also been anticipating higher inflation after Donald Trump's surprise election victory. There's clearly the potential for good inflation arising from greater fiscal stimulus, as Donald Trump is targeting tax cuts and a boost to public spending. There's also speculation that inflation could head even higher should Trump follow through on his campaign rhetoric to raise tariffs. Inflation was already on the way up in the US as economic growth has caused a tightening in the labour markets, and US inflation-linked bonds have moved to price inflation of around 1.9% after his win, which looks around fair value to us. We've been reviewing our inflation estimates, with both the Fed and Bank of England targeting 2% inflation. We're assuming inflation modestly above these targets for the UK and US, as the policies look fairly accommodative. These assumptions are important as they underpin our fair values and our valuation implied returns, both for equities and bonds. And as always, we'll look to move our portfolio towards those asset classes which look the most attractive based on these implied returns.